You know the Hollywood portrayals, right? The flashing headlines on financial networks. Well, today on The Explainer, we are completely bypassing that financial glamour. We're going to look strictly at the mathematical and structural reality of hedge funds. Does the data actually justify all that intense mystique? For decades, these funds have been pitched as the absolute pinnacle of wealth building, a VIP room reserved only for the financial elite. But when we actually pop the hood and examine the mechanics, the performance, and, oh man, the fees, a very different picture emerges. So let's dive right into this. Pop culture really loves to paint this specific picture, kind of creating an aura of a secret society of absolute financial geniuses who can literally move global markets with just a single phone call. It naturally creates a sense of awe and, frankly, a bit of intimidation. But let's toss aside the cinematic drama for a second. Today, the hedge fund industry manages upwards of $4 to $5 trillion globally. That is an enormous amount of capital sloshing through the system, and it's mostly driven by quantitative models, intense research, and strict institutional mandates. We're going to strip away that mystique and look at how these massive institutions actually deploy all that cash, how they're structured, and what that means for the rest of the financial ecosystem. Now, as you probably already know, at its core, a hedge fund is simply a massive, privately managed pool of capital. It gathers money from the big institutional heavyweights. We're talking pension funds, university endowments, and ultra-high net worth individuals. But where it severely breaks away from standard institutional investing is in its mandate. They simply aren't boxed in by the same regulations that govern a standard mutual fund or that everyday index fund sitting in your retirement account. This regulatory freedom allows these managers to actively and sometimes hyper-aggressively hunt for microscopic inefficiencies in the market. It's a mandate that goes way, way beyond just buying a broad basket of stocks and chilling for the next 10 years. Because they operate with that expanded mandate, the toolkit these managers play with is vastly different from your standard retail portfolio. We are talking about aggressive deployment of short selling, heavy leverage, and incredibly complex derivatives. But look, they aren't just throwing these tools at the wall to see what sticks. The goal is often to create market-neutral portfolios or to exploit massive arbitrage opportunities. When they use leverage, meaning they borrow significant capital to amplify their positions, they're trying to turn a fraction of a percent market inefficiency into a massive windfall. But, as financial history has shown us time and time again, while the upside of this leverage can be absolutely astronomical, the downside? It can trigger catastrophic liquidations that ripple through the entire banking sector. And this brings us to one of the great ironies in modern finance, the very word hedge. Historically, if we go all the way back to the first credited hedge fund created by Alfred Winslow Jones in 1949, to hedge meant exactly that, to protect yourself. The strategy was to offset risk by holding long positions while shorting other stocks, theoretically protecting the portfolio if the broader market crashed. Yet today, the modern reality is often the exact opposite. Many of today's most famous funds frequently take on massive, directional, speculative bets to chase those sky-high returns. We have literally seen modern funds blow up spectacular amounts of wealth by amplifying risk rather than avoiding it. The name just stuck around purely out of tradition, even as the actual application drifted a million miles away from its safe, protective origins. Hearing about these multi-billion-dollar pools of capital and these insanely complex strategies naturally breeds a sense of FOMO, right? The fear of missing out. You might be looking at your own portfolio and wondering, how do I get a piece of that institutional action? Well, if you're feeling that FOMO, you should know there is a massive structural barrier keeping everyday retail investors completely shut out. There is a metaphorical and honestly quite literal velvet rope that dictates who gets inside the club and who has to stay on the sidewalk. It's an entire ecosystem built fundamentally on exclusivity. In the US, you generally can't just open a standard brokerage app on your phone, search for a top-tier hedge fund, and hit buy. It is literally illegal for them to take your money unless you meet a specific legal standard known as being an accredited investor. This is a super strict legal category set up by the SEC, which generally requires an individual to have an annual income over $200,000 or $300,000 with a spouse for the past 2 years, or a net worth exceeding $1 million, and that entirely excludes your primary residence. The regulatory logic here is that these funds are simply too risky, too opaque, and way too complex for everyday people. So they can only accept capital from folks who can, theoretically at least, afford to lose it all. But let's say you do meet those regulatory thresholds. Standing on the right side of that velvet rope is staggeringly expensive. This brings us to the absolute lifeblood of the industry and the exact mechanism that turns fund managers into billionaires, the notorious 2 and 20 fee structure. For decades, this pricing model has been the absolute gold standard for high-stakes investing.
It basically operates as a massive toll booth for anyone wanting access to those advanced market-neutral strategies we were just talking about. So here is exactly how 2 and 20 works in practice. The 2 stands for a 2% annual management fee on total assets, meaning if you park $10 million with a fund, they take $200,000 every single year, regardless of whether they generate a massive return or lose half your money. That fee is guaranteed. The 20 is a 20% performance fee on any profits they generate. As we discussed in our previous explainer covering the brilliant insights of Victor Hagani, fees matter tremendously. Paying a 2% base fee plus handing over a fifth of your upside creates this compounding damage to your wealth over a multi-decade horizon. That damage vastly outweighs a basic index funds fee, which is usually just a tiny, nearly invisible fraction of 1%.
And here is where the mathematical reality really comes home to roost. You're paying a massive premium for elite financial minds using incredibly complex strategies, so they must inherently crush the market, right? Well, the historical data actually paints a very different picture. When you have to dig yourself out of a 2% hole every single year and hand over 20% of your wins, beating a simple, unmanaged S&P 500 index fund over a decade is incredibly difficult. Just look at the famous million-dollar bet Warren Buffett made back in 2007. He wagered that a standard S&P 500 index fund would outperform a basket of top-tier hedge funds over 10 years, after fees. A decade later, the index fund had compounded at over 7% annually, while the hedge funds limped in at just over 2%. The passive index absolutely crushed the elite managers. No contest. Which brings us to a crucial myth-busting moment for us. The myth we've all been heavily sold is that exclusive, expensive, and complex automatically equals guaranteed better returns. We naturally assume that because we aren't allowed in, whatever is happening inside must be absolute magic. But the ultimate truth, backed by decades of financial data and that famous Buffett bet, is that exclusivity does not equal outperformance. The reality is that the high fees and the incredibly high risks often completely outweigh the hype. A lot of the prestige you see in financial media is driven by brilliant marketing and this aura of wealth, rather than actual, consistent, market-beating results for the end investor. So what does this all mean? What's the core takeaway from this mathematical reality? You can officially ditch the financial FOMO. Seriously, you don't need to stress about missing out on these highly secretive velvet rope funds. They are wildly expensive, unnecessarily complex, and mathematically, they often lose to the simplest passive investing strategies available to anyone with a smartphone. Instead of worrying about the secret clubs you can't join, make sure you subscribe to Grovy so we can keep focusing together on the straightforward, low-cost strategies that actually build long-term wealth. You have the power to actually become rich, instead of just paying massive fees to watch other people pretend to be rich. I'll leave you with this thought to chew on until our next explainer. If the most elite, highly paid financial minds in the world routinely fail to beat a basic, boring index fund, who is really the genius?